Well, we know Australia has a very over-leveraged consumer, certainly when you compare it to the rest of the world. The thing that's been notable, though, is that when you look across the world, we're running at higher debt levels than we were pre-GFC levels. And what's really worrying for me is the fact that a lot of that debt has been built up in emerging markets. And that's one of the reasons why we expect the US dollar to be so strong. Ultimately, if you're in a world which has higher debt levels, it can't handle higher interest rates. And that's been a mantra of ours for a long time now, that while you have these high debt levels, you have to keep interest rates low or lower to be able to support the economy. As soon as interest rates start moving, it has a knock-on impact to growth very quickly.
Do you think that's front and centre in the minds of central bankers at the moment?
Yeah, I think so. I think in a world where everyone is devaluing their currency, we're getting competitive devaluations of currencies, any country that looks like it might move interest rates higher is seeing a marked appreciation in their currency. And so what that means is that they get a slowing impact immediately on their economy, and that's what the US has seen. So they've seen the US dollar appreciate materially. Now the US economy is slowing via profit sector, via exports and also imported inflation, and what that means is they're stepping away from the interest rate hikes they'd put in. We weren't surprised at all that the Fed didn't hike in September, and we don't think it's likely they go in December either. Very much so. There's a belief in the markets that the dollar is strong because the Fed is expected to raise interest rates. We think about it the other way. We think the dollar is strong by itself, and that's because there's forced buying as people close out the liabilities they had in dollars that were built up post GFC, and the dollar strength is actually independent from the rate cycle, and therefore the dollar going up curtails the rate cycle. So we think about it the other way around. So we think the dollar's going up irrespective, therefore it means they can't raise interest rates. And there's a number of feedback mechanisms from the stronger dollar to the US economy. Yeah, I was writing about that back in January of this year, so nearly a full year ago, that we thought that there was a good chance they wouldn't hike rates at all this year, and that the next move would be another quantitative easing package. At the moment that doesn't look that likely, but I certainly don't believe we're in for a sharp hiking cycle anytime soon. And if they don't hike rates soon, well then I think they lose the window of opportunity to do so, because the US economy is clearly slowing here. If we get into Q1 and they haven't hiked rates, well then we get the echo of the GFC, which means Q1 and Q2 are generally weak, and then we're into the presidential cycle. So if they're going to hike rates, they need to do it soon, because otherwise I don't think they're going to get a chance to.